there are other two methods. They're not converting the values to a different timeline, but they are to calculating. They are calculate the interest rate, okay, going on the timeline, and compare that interest rate with your MARR. So if that interest rate is bigger than or equal to your MARR, then you're gonna accept that project. Otherwise, you're going to reject that. Okay, so in what cases you want to use this different type of method? So this method, the first of that two methods, is called internal rate of return. Internal, okay. The next method is gonna call the external. So just give you a heads up. It's shortened as IRR. Okay, internal rate of return. When do you use it? So this method solves for the interest rate that equates the equivalent worth of cash inflows to the equivalent worth of cash outflows. Okay, what does it mean? So the equivalent worth of all the cash inflows, you can consider it as the revenue, right? Because every year you have income. In the end of the timeline, you also may have income. So all of these incomes, if you convert that to the present worth, that's the present worth of all the revenues, right? All the incomes. And also, you might have costs, expenditures going on. You need to pay the initial price, right, to buy the equipment. And every year you need to have a maintenance cost, operation cost, right? And at the end of the timeline, you might have disposal cost. If you don't sell it, you might want to trash it. But to trash it, you need to pay, okay, sometimes, if it's a huge metal equipment, hard to recycle especially. So if you convert all of these expenditures, expenses back to the present time, you're gonna have a present worth of all the expenses. Okay, so as a businessman, what do you want to do? We said we always want to at least have our expenses recovered by our revenue. Okay, so that we gain nothing. At least we're not losing money. Okay, we're even. So that's why we want to have them equal to each other. And the I prime percent, which can make this equation happen, that is called the internal rate of return. Okay, so you can imagine you're gonna have some factor method on the left side, some factor method on the right side, and all of them, what you don't know is the I percent. Okay, you know the cash flow, you know what factor you're gonna use, but actually you don't know what I make them equal to each other. So you're gonna solve that equation to find out the I prime percent. In our class, we don't need to do the calculation of that. It's very complicated. But the takeaway is the I prime percent is something can make your expenses recovered by your revenue. Just make it even. Okay, so that you don't lose, you don't gain, you just make even case. And that I prime is called internal rate of return. Why it's called internal rate of return? The internal means all the revenues generated by the project will be reinvested at the same I prime percent in the same project. Okay, imagine that you're your iPhone company and you sell iPhones, and all the revenue you get from selling the iPhones will be reinvested into the production or design of a new iPhone, right? So you're gonna re-input the money, all the money you gain into the same business. Implies that the I prime, the interest rate, stays the same. Okay, that's why it's called internal rate of return, because you're still keeping the money in the same project. Okay, and once you solved the equation and you get the I prime percent, you're gonna compare that with your MARR to see if it's bigger or equal or not. So if it's bigger or equal to the MARR, then you want to say that proposal is acceptable. Otherwise, you're going to reject it. Okay? So the IRR is actually referred to as the break-even interest rate, right? Because you're making this equation happen. And when it happens, you just make an even case. You don't gain money, you don't lose money. You just keep your cost recovered, okay? Barely recovered. And here is just the equation I was talking about. So on the left side, this is all the present worth of your revenues. R is revenue. And on the right side, it is the present worth of all your expenses. So you want to make your expenses recovered by the revenue, which means you want to make these two sides equal to each other. Okay? And this is how you calculate the unknown I prime. And there are some warnings to use the internal rate of return. So what it can be used is to compare IRR for one project to MARR to answer the yes or no question. Okay, so if you have a single project, you want to say yes to it or not no to it, you use the IRR method. But what you cannot do is you cannot calculate the IRR for different projects and to compare the IRR. You might imagine, okay, I would compare all of the projects to see whose IRR is the highest, so I'm gonna pick it. No, because you remember the IRR is just break-even interest rate. So means whichever IRR case you take, you still don't gain money. That's not what you want, right? What you want is you gain money, you have positive profit, okay? But if you just compare IRR for different projects, all of these IRRs are only make break even, okay? And so although one IRR could be higher than the other IRR, but that project will do the same thing. It only gives you an even case. You don't gain any profit out of any of them. So that's why you don't want to compare IRR to another IRR. Okay, you just want to see one single IRR if it's bigger than or equal than MARR. Okay. Because if it is higher than your MARR, which means if you use MARR to convert the cash flows, you're gonna get positive present worth or future worth or annual worth, and that's what you want. Okay. And also IRR. This is also very important. It assumes that the cash inflows is reinvested at the IRR in the same original project. That's the iPhone example I just gave you. The IRR does not work when the revenues are reinvested in another project, which we can say external project, with a different interest rate. So say if you sell iPhones and you have some profits, but you didn't reinvest that profit into your iPhone business. You instead invest that profit into a television business, okay? And that television business is going to have totally different interest rate compared to the cell phone industry. So in that case, you cannot use IRR method. So what do you use? That's the case when you want to use the external rate of return method. Okay, so when do you use ERR, the external rate of return method? when the revenue generated by a project cannot always be reinvested at the IRR, means you need to reinvest it into another project with a different interest rate. In that case, you want to use the ERR, okay? And then another concept is the epsilon percentage. The epsilon percentage is also an interest rate, but that is the interest rate for the external project, okay? So that's the external project you reinvest your profit. So the ERR method allows for an external reinvestment interest rate, which is written as epsilon percent, to be considered, okay? So epsilon percent is the rate that cash flows generated by the project externally, okay? So this is another very important point is the ERR, external rate of return, is not the epsilon percent. So there are different concepts. Don't get confused, okay? Don't confuse these two things together. And let's just generally talk about the method. You're not going to, use the equation to calculate the ERR, but I still want you to understand this, the method, because it is a very real world problem. So the method is, when you want to calculate the ERR, you want to first have all the net cash outflows discounted to time zero. At what interest rate? At the epsilon percent. Because you're reinvest all the money to another project with the epsilon percent as your interest rate. Okay? And the second step is you want to convert all the net cash inflows to a future time with the epsilon percent, which means all the receivings you get from the project, you're going to reinvest that to a future time, to this external project. And the ERR is the interest rate I prime that establishes equivalence between these two quantities. So first, you convert all the outflows, so the spendings, and back to the present time at the epsilon percent, because you imagine that those spendings you could have invested them into another external project, okay? So you want to convert them back to the present time. And then all the inflows, the receivings, the profits you generate from this project, you imagine that you could invest them into another external project, okay? But that will happen in the future because the receivings are all the money you get now, and you can only go to the future time in reinvestment. So you convert all of the inflows to the future time. But there is I prime percent, which can make these two quantities, right? The out cash flows and the outflows and the inflows cash. There is some I prime can make them equal to each other, which means you don't lose, you don't gain. It's still a break-even case, okay? And that I prime is ERR. And at the end, you want to compare that ERR with MARR to see if it's higher or equal to the MARR. If yes, you want to accept that project. If no, then you want to reject it. So this is the long equation we're talking about. And you can see that this part is actually to convert all the expenses or the outflows, cash outflows, back to a present time, okay? To a present time. And then on the right side, this is to convert all the revenues, the incomes, to a future time. And you see that these conversions are made by using the epsilon percent. That's the interest rate of the external project. So now we're looking at some I prime. okay? That I prime can make these two quantities equal. But to make them comparable, we said we always want to convert the cash flow to the same time spot, right? So we choose to convert the present value to a future value using this factor. Okay, so first we convert the expenditures back to the present time, and then we use the I prime to convert it to the future time, and then we equate it with the future revenues. So if you solve this equation, you can find out this I prime percent, and that is the ERR. Okay, so this is the external method, and then I want you to just understand the logic behind it. The logic is you just imagine that all the cash flows from a project, you could have imagined the costs at an earlier time on the external project. You also can invest the income of this project in a future time into that external project. And that's the case when you want to use the external rate of return method. Okay, the last concept is called payback period. Okay, so the payback period is talking about the number of n. So it tells you the number of years required for cash inflows to just equal cash outflows. Okay, so you have the initial payment for equipment, and every year it recovers some of your cost. But you want to know, when do I have all the initial costs recovered? And then the time later than that, that's your pure profit, gaining time. That's the time. So to the years after that, payback period is gonna be the time you just purely get your profit. Okay, so that's the payback period method. And the payback period is often thought of as a measure of risk for a project, because if it takes longer time, then the risk is super high, because you never know, like after 10 years, what's going on in the market. Although you can get your cost recovered after 10 years, but well, maybe at that time something bad will happen. So the longer payback period is, the higher risk you're gonna take. So tell me, it's just a very common sense. Do you want the payback period to be long or short for an investment? Okay, just make your common sense. Of course, we want it to be short. We want to invest something, and then we even want to get all the cost back tomorrow, as fast as you can. Okay, so the payback period method, you always want to have a shorter payback period if you compare different projects.